Good morning, guys. It's 8:46 in the morning, October 21st, and I got a DM over the last night asking a question about how are we able to discern uptrends and downtrends on major market indexes, and what are the most important indexes that we watch inside of TTI. I figured this would be a pretty good video topic to make. Hopefully it helps other people with similar questions, specifically guys that are coming into the group that are newer. And if you're not enrolled in the TTI swing trading course, a lot of this material is covered in depth in there. So that's an option for you later on down the road. I'm going to try to make a brief answer here to get you guys on the right path though. So for all intents and purposes, uptrends, right? Higher highs, higher lows. Higher highs, higher lows. This is like the classic description of how you identify uptrends. You can draw a cute little trend line. Then you have your downtrend, which is your lower high, lower low, lower high, lower low, right? And you can draw your cute little downtrend here. And this is the textbook answer of how you're able to discern between an uptrend and a downtrend. Now, according to Dow Theory, Wyckoff market model, there's many different types of trends on a chart. Without going too deep into them, I'm just going to say that we focus on the primary and the secondary trend or the intermediary trend most of the time. Primary trend meaning if we zoom really far out, which direction are we moving? Well, if I zoom all the way about to 2016, and I said, for the most part, which way is this chart moving? You're going to say, well, it's going up over time. The primary trend is up on a macro time frame. And as a matter of fact, we know that in general. That's how markets work. That's why there's an edge in going long over going short, because we know that over time markets go up. Let's go ahead and remove that really quick. Secondary or intermediary trend might be something like what we've seen over the last 6 months, which is a downtrend, right? We can see this. So it's hard sometimes to take the textbook answer and pin it because, for example, what happens here, right? We're in a structural uptrend. In this case, it would still be part of the primary trend and the secondary trend. What do we do here? Where we fail to hit a series of higher highs and we are essentially range bound for multiple months in a row. This could signal, and it did at the time, risk. Maybe the market is about to reverse to the downside. This was not necessarily an easy opportunity to trade. We were trading it as a group. And because we like to buy horizontal level breaks, we were able to buy the breakout and continue right up. But this chop zone right here was not easy to trade for anybody. So it's not as cut and dry as higher highs and higher lows. Of course, it's an uptrend. Hindsight, of course it was. But at the time, this was very hard. So that's why we look at a couple other different ways to discern whether or not the trend is coming to an end. We could look at the RSI, if you have other momentum indicators, etc. Okay, so uptrends, like I said, textbook, higher highs, higher lows, and you could just append the higher highs, right? Higher high, look for little resistance areas. That's what we would consider higher highs, and then you get the peak, and then you get the subsequent lower highs and the lower lows, right? So it's an up and then a down. Hindsight makes this very easy, but most of you guys have been in the group for over a year, so you know that this was not necessarily the easiest time to switch biases back to going bear, right? So textbook answer, there you go. That's how you're able to discern, and this is the same across every ticker. Anything with the chart, right? Anything with price action is going to have uptrends, downtrends, and sideways consolidation ranges. But this is how you're able to identify these. Now, the second part of the second part of the first question, is what about the 200-day moving average? So the 200-day moving average is incredibly important, not necessarily for our trading system, but for our analysis. And the reason why is because it's important to everybody. Now, it's a lagging indicator, as all moving averages are. And you can use it a bunch of different ways. Some people use it as a leading indicator, right? If they're trying to front run something like a moving average crossover, that would be a leading indicator. But for all intents and purposes, most people use this as a lagging indicator, and they use it to divide sentiment. If price is trading above the 200-day moving average, you should be looking more so to go long. And as soon as price eclipses that 200-day moving average and comes underneath, you should be looking to go more often short. That is the institutional textbook answer on what a 200-day moving average does. It doesn't work out perfectly. As you can see, we broke below the 200, we jumped back up, we broke back below, we jumped back up. So this period right here for somebody that was simply trading the 200-day moving average crossover was not a very profitable time. So obviously you don't want to use any one indicator solely, but the 200-day moving average is a great sentiment check. If we're trending above it, we should be looking to go more long than short. If we're trending below it, which we are right now, we should be looking to go more short than long. It really is that simple. in terms of analysis. So like I said, right now we are firmly below the 200-day moving average. 200-day moving average right now is around 414, 415, and we're currently trading at 365. So we are very far off of that 200-day moving average. So we should continue to be more short biased than long biased. Now, it doesn't mean that we have to put an incredible amount of risk into these shorts if we're finding other areas of the market that may have support. If some oscillators or momentum indicators that we're using are telling us to slow down, we understand that. We have an edge in this. But that's how you would use the 200-day moving average when discerning uptrends and downtrends and giving you a little bit more oomph for your ideas, right? So as soon as we cross below the 200-day moving average and we're in a series of lower highs and lower lows, you know you should be shorting more often than not. Second part of the original question was, what are the indexes that we should be focused on? So I'm just going to go ahead and type them out. We should be focused on SPY. And this is all taken from the context of Dow Theory. These particular indexes were not around when Dow was around, but this is the same simple concept. We want to try to look at the indexes that represent the most amount of the market and in terms of different market caps and different focuses. So SPY is obviously going to be your S&P 500. It's the perfect benchmark for a total market snapshot, if you will. So this is why everybody focuses on the SPY. This is the general benchmark for the entire market's health and the way that it's moving, right? So the Qs are going to niche out the growth companies. That's why we focus on the Qs, because obviously we understand that SPY is comprised of growth and value. The Qs are simply growth, and historically speaking, at least over the last 12 to 15 years, growth has been the focus of the market. This is where a majority of the profits have come from. So therefore, we are looking at the Qs. It might not always be that way. Remember yesterday's strategy session. IWM is your small caps, your Russell. This is going to give us a better idea of where risk is moving in the market, because we understand that risk is going to be coming into the market through these small caps before necessarily the large caps, because there's more potential opportunity to make money in these small caps. You're not going to see Apple quadruple. You're not going to see Apple go to $1,000 a share in 6 weeks, but you will see a lot of these small caps double, triple, and quadruple at that same rate. And therefore, when we start to see IWM pop back up, maybe prior to the legacy indexes, SPY, etc., we can infer that maybe risk is coming back in. We'll start some more risky behavior going along some smalls, maybe some mids, etc. And then obviously the old giant, the Dow Jones Industrial Average, always a good place to look as well. You can use the Dow Jones Transportation Average, and you can use Dow Theory there. You can look at the differences between the industrial average and the transportation average. And for those of you that are in the TTI swing trading course, we do that inside the course, right? And we look for divergences, which could be yellow and or red flags in the market. But for all intents and purposes, we focus on SPY, Q, IWM, and the Dow Jones to a certain extent. We run modern day Dow Theory based off of these three, though, right? SPY, Q, and IWM. Not a better example than last November, I think it was December, when we were looking at the relationship between IWM and SPY. We saw IWM breaking to the downside prior to the broader market. If we look at it really quick, you can see IWM peaked in early November and then started to break down in late December, beginning of January. We actually niched down even earlier than that. We went to IWO. Remember, we shorted this IWO capitulation zone. And if we actually go and we look at some of the big boys within SPY, we see that SPY actually held on for a lot longer, right? SPY didn't actually start capitulating, and people didn't start actually freaking out until the end of January, beginning of February. So IWM front ran the capitulation. We were able to notice that, take positions. So that's why these three indexes are what we focus on every day. And once again, Dow Jones Industrial Average there is important as well. Okay, so any questions regarding the uptrend, downtrend, 200-day moving average, etc., feel free, ask them, respond to them in the video. Hopefully this helps iron out some people's questions though. So I'll make some new videos if there's any additional questions. All right.